At this very second, Hyperscale Data Inc., trading under the ticker GPUS, is exchanging hands at exactly $0.339. We are looking at a market cap hovering right around the $115 million mark, and the intraday action is showing a tense, consolidated pause after a massive volatility spike, currently sitting flat to slightly down on the hourly candles, despite a massive 15% surge in the previous session. If you are watching the order book on your Interactive Brokers trading screen or checking the tick-by-tick data on your Fidelity mobile app, you are seeing a battleground. The bid-ask spread is tightening, volume is surging past 23,000 shares in the pre-market alone, and the sheer velocity of orders suggests that retail and institutional algorithms are fighting for position. This isn't just a penny stock drifting in the wind. This is a highly active, high-beta asset that is currently reacting to a very specific set of catalysts. Now, let's address the elephant in the room immediately. The expectation here, the narrative you will see floated on message boards and by casual observers, is that GPUS is just another rebranded, dilated small-cap tech play trying to catch the AI wave by changing its name from Alt Alliance to Hyperscale Data. The expectation is that this is a trap, a company that issues shares to survive while promising future growth that never materializes. That is the cynical, safe take. But the reality is substantially more complex and, frankly, more interesting. The reality is that this company has effectively transformed itself into a leveraged derivative on two of the most explosive trends of the decade: the physical infrastructure shortage for artificial intelligence and the corporate treasury accumulation of Bitcoin. You are not just buying a data center company, you are buying a holding company that is aggressively converting its liquid capital into digital scarcity while the rest of the market is still debating the value of the dollar. The market expects a failing legacy business. The reality is a restructuring engine that has just hit a critical milestone of $70.5 million in Bitcoin holdings. Let's establish some common ground before we tear it apart. Most people looking for exposure to the data center boom gravitate toward the obvious names. They look at NVIDIA stock and think about the chips. They look at Tesla stock and think about the compute needed for autonomy. They might even use Schwab Intelligent portfolios or SoFi Invest to allocate capital into broad tech ETFs. That is the standard logical path. It makes sense. You want safety, you want exposure, you go where the liquidity is deep. But here is the contrarian angle that forces you to rethink the GPUS proposition. The top-tier plays are priced for perfection. NVIDIA stock is priced as if it will dominate forever. But the small-cap infrastructure plays, the ones like Hyperscale Data that own the actual dirt and power, the Michigan and Montana facilities, are trading at valuations that barely reflect the replacement cost of their assets. The market is pricing GPUS based on its diluted past, not its asset-heavy present. When you utilize Fidelity Investments research tools or even the basic charts on the Robinhood app, you see a chart that looks broken. But if you look at the balance sheet restructuring, you see a company that is systematically divesting its non-core assets to become a pure-play fortress of compute and crypto. You are not just buying a data center company. You are buying a holding company that is aggressively converting its liquid capital into digital scarcity, while the rest of the market is still debating the value of the dollar. Let's analyze the recent stock movement, because the tape tells a story that the press releases often miss. Over the last few trading sessions, we have seen GPUS explode off its 52-week lows of $0.20, climbing nearly 70% in a short time frame before stabilizing here at the 0.34 level. This is not accidental noise. This is high-volume accumulation. We are seeing daily volumes exceeding 50 million shares in the pre-market alone. And to put that in perspective, for a stock with this float, that indicates that the entire shareholder base is turning over rapidly, flushing out the weak hands who held through the decline and replacing them with aggressive, risk-tolerant capital looking for that lottery ticket upside. When you see Interactive Brokers stock trading volumes light up like this, it usually signals a liquidity event, either a massive exit or a massive entry. Given the news flow regarding the Bitcoin Treasury, the data suggests the latter. The market is waking up to the fact that at a $115 million market cap, holding $70 million in Bitcoin means the actual operating business, the data centers, the revenue, the contracts, is being valued at next to nothing. You are buying the Bitcoin at a discount and getting the AI business for free. This brings us to the core of the analysis, the Bitcoin strategy. This is the wedge driving the current price action. Hyperscale Data has explicitly stated its goal to reach a $100 million Bitcoin treasury. As of this week, they're sitting on approximately 382 Bitcoin. If you are using Robinhood Crypto or Coinbase, you know that Bitcoin has been hovering near all-time highs, trading around $86,000. Do the math. The company is essentially becoming a closed-end fund for Bitcoin, but with an operating arm that generates the energy and compute to create more of it. This is a flywheel effect that retail investors love, but institutional algorithms often struggle to price. A Fidelity wealth management algorithm looks at cash flow and debt. It doesn't know how to value a company that is purposely hoarding a volatile asset. This pricing inefficiency is where the opportunity and the extreme risk lives. Furthermore, we need to discuss the hyperscale in the name. This isn't just marketing. The company operates the Michigan AI Data Center campus. In an environment where power availability is the single biggest bottleneck for AI deployment, where companies are waiting years for grid connections, having a plug-and-play facility with active power capacity is a tangible, sellable asset. The rent for these spaces is skyrocketing. While Amazon and Google build their own, the mid-tier market is scrambling for capacity. GPUS is positioned to capture the overflow demand that the giants cannot service. This creates a floor for the stock's fundamental value that the technical chart doesn't show. However, we must remain objective and professional. We cannot ignore the risks, and this is where we have to look at the short case. The reason this stock trades at $0.34 and not $5 is dilution. The company has a history of funding its operations and acquisitions through the issuance of stock. When you use Fidelity Trading Platform or Interactive Brokers fees calculators, you realize that the cost of holding a stock that dilutes you is high. The Series F exchangeable preferred stock issuance mentioned in recent filings is a complex instrument. It is designed to facilitate the spin-off of Alt Alliance, but in the short term, it adds layers to the capital structure that confuse the average investor. The smart friend explanation is this. The company is slicing itself into pieces. It wants to separate the good assets, data centers, Bitcoin, from the legacy assets, lending, defense, textiles. If this surgery is successful, the GPUS shares you hold today could be the clean, valuable remnant. If it fails, or if they run out of cash before the split is complete, the dilution could continue to suppress the price indefinitely. Let's talk about the mechanics of trading this. GPUS is an NYSE American-listed stock, which means it has better liquidity and reporting standards than an OTC pink sheet, but it still trades with the ferocity of a penny stock. If you are using SoFi Active Investing or Robinhood fractional shares, you need to be careful with market orders. On a stock moving 15% in a day, a market order can get filled at a price significantly higher than you intended. You want to use limit orders. You want to watch the level 2 data. You want to see where the walls of resistance are. Right now, there is a significant psychological wall at $0.35. If the bulls can push the price through $0.35 with sustained volume, the next technical resistance isn't until the 0.45 to 0.50 range. That is a massive gap that could be filled in days. Conversely, if 0.35 holds as a ceiling, we could see a retest of the 0.28 support levels as the momentum traders exit. Comparison is a powerful tool for understanding value. Consider SoFi stocks or Robinhood investments in other high-growth areas. When you invest in a company like Palantir or SoFi itself, you are paying a premium for growth that is expected years down the line. With GPUS, you are paying a deep discount for assets that are already on the books. The market is applying a management discount, essentially saying, we don't trust you to unlock this value. This is the tension I mentioned earlier. If management executes the spin-off in Q2 2026, that discount evaporates, and the stock re-rates. If they delay, the discount deepens. Now I want to pause and ask you a question because this is the crux of the investment thesis. Comment below how many shares of Hyperscale Data you currently hold. And, more importantly, do you believe the management team will actually stop the dilution and let the Bitcoin Treasury do the heavy lifting? Or is this just another cycle of capital raising? I want to hear your thoughts because the sentiment on this